Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen. I'm Richard Morchoe. We have conversations with, in the Long Hill Report, with our finance guy, Mike Carnevale, who is going to tell us where we are in the world. Things have been tumultuous. The Fed has raised rates. The trade deficit is way up. Is there any reason for hope? Michael.
Well, there must be, because you said good afternoon, not bad afternoon.
I take your point.
Okay. So April, it was 100 years ago that T.S. Eliot wrote April is the cruelest month.
Yeah. Is it following along?
It's following along.
Cruelest month.
A month ago, we were talking about, how great April was going to be because historically, up 9 years in a row, 15 of the last 16 Aprils were positive, and we're going to be all right. Not this year. For the record, April was down 4.9%, but that was for the Dow. The other indexes that people look at, Standard & Poor's or the NASDAQ, were down a lot more than that. So was not a good April. In fact, the market has been down 5 straight weeks. And the Dow is now negative year over year for the first time in years, meaning the Dow was higher a year ago than it is today, and we haven't seen that in a number of years. So it's a very, 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 April was a very tough month.
Well, you're going to give us some reasons for hope, I hope.
There's always reasons for hope, and there's a couple of really good ones, I think, that, we're going to try to hang our head on for the month of May. Interest rates rose in the month of April in anticipation of what the Fed did in the first week in May. The 30-year Treasury is now close to 3%. A month ago it was 2.5%. So no doubt that, rates are starting to increase. And sometimes you can look at what happens with the 30-year as sort of as a proxy for how, the institutions think the Fed is doing. Recall for a long time, the 30-year was not really moving. And that would lead you to believe that institutions had faith that the Fed could pull us out of this. That kind of changed in the month of April. Government bonds, Treasury bills, notes, bonds, all saw yields go up quite a bit. And that would lead you to think that some people are a little bit more concerned today than they were a month ago. We look at the technical indicators. Well, we just said, right, April was a horrible month. So you got to think the technical indicators look great, and they actually do. No sense mentioning them by name. Just suffice to say that all three are at levels we haven't seen in over a year, meaning the stock market has really taken it on the chin. Technical indicators show that, and that's what we need to see if we want to see a rebound. And we're there right now.
We're down. I know it's unfair to look for predictions, but
yep.
All right, we have the moving average, the New York Stock Exchange 200-day moving average, 31% versus 30%. 37% a month ago.
Right.
Could we do better by getting to 22 and having a better, more of a rebound as time
Yes.
goes on?
Yes.
So we'll look for that next month.
Could look for that next month. However, historically, anything under 40 has preceded an upturn. So the fact that we're below 40 now, you could see a turnaround at any time. Of course, it could go to 22 or 20.
We were at 37
We're
last
at
month.
37.
We should have seen a bounce.
Could have seen a bounce there.
We didn't.
Right.
Okay. So, ladies and gentlemen, if you want to wait till it goes to 5 and then jump back in the market, we are not going to stop you.
Correct. The thing being, you may not get there.
Yes, that's true. So, timing is everything.
Correct.
I think I was born in the perfect point for most of my life. The United States was quite prosperous. It's only now that things are getting a little dicey.
Yep.
So luck takes a lot of, timing and luck. If you get that right, folks, you've got it all.
Yeah. And a lot of times you don't have the luxury of the time. When you were born, you didn't have the luxury to say, well, wait a minute, I'm going to wait a couple more years. It just happened.
I'm glad I was born when I was born.
Yep.
So, stochastic and oscillator price in relation to support and resistance level over a given time period.
Right.
38 versus 54 a month ago.
Yep.
That seems a little big.
Yep. Yep. Anything between 20 and 80 is okay. The lower it goes, the better, because that means sets you up for a better recovery. You see we're still dropping, and we're now in the lower half, the 20 to 80, 50 would kind of be the medium point. We were at 54 a month ago. We've dipped below that now, so that's a positive indicator.
If we went, and I'm not saying I have any idea if this had happened, if we went below 20, would that be panic mode?
No, that would set you up to just like the 200-day moving average where you were oversold.
So,
And you want to get, ideally, to that level. You may not, though.
it wouldn't say we are in a very
No.
bad position. Okay.
No. No.
What would say we were in a bad? Not that I'm Mr. Well, maybe I am, but not that. What would be a bad statistic?
A bad statistic would any high number. The higher the number, the worse. Because that means
we're closer to going down.
That's right. So the fact that you're closer to zero, you're actually in better shape than if you were the opposite.
So
Lower is better.
now, making myself out to be completely ridiculous, what if we went to a negative number in this?
You could never, because the lowest is zero in
The
any of
lowest is
these.
0.
Right.
Okay, and then we all just climb back and just buy.
Yep.
It's not going to 0. We know
It's not going to 0, but anytime now, it's the indicators say, the technical indicators talk about direction, not necessarily timing. So you can stay oversold for a very long time, and you could stay on the flip side of that overbought, meaning high, for a very long time. It's just telling you what the likely direction is going to be. It doesn't pinpoint the timing, the date that it's going to happen.
Okie doke. Okay.
That's the thing that I think we want to keep in mind, that there's not going to be a magical day that it happens. It's what the trend is. Okay, the trend is lower. Okay, so that means we're closer to the bottom. Doesn't say the bottom is tomorrow, though. It just says we're closer to it.
Okay. But Mike would not come here without some good news.
Absolutely not. We do have a lot of good news. Good news, we'll finish up with the bad news.
Okay.
The Wall Street saying of sell in May and go away, come back Halloween Day. We're entering what historically is the weakest 6 months of the year for stocks. The average annual return from May 1st to October 31st, the average annualized return is 0.3%. Put it another way, 96% of all stock market gains have occurred outside the May to October time frame.
So you probably could tell us, what are we just going away and forgetting the market, going to the beach?
Well, that's a lot of, and of course, the world has
garden.
changed now, right? But yeah, historically the thinking was, yeah, all the big institutions take the summer off, they go away for an extended period of time. So there's not a lot of, there's less trading going on, and there's less, some of that is still true, but the world is a totally different world than it was in the 1950s and 60s. It's much more technologically connected, so may not have as pronounced an effect, but it's still, I think it's still significant. And what it does is it sets you up for not being disappointed. In other words, people become too emotional. And for instance, if it snows in December, you don't get excited. Snows in July, you tend to get excited. So the May to October time frame historically is not a great time period for stocks. So if you know that going in, and you end up with a not so great May to October, why would you get excited? You kind of knew that historically that's what happens.
It is what is to be expected,
Right.
is what you're saying.
Correct. And with that, we end all the bad news. Everybody get up off the mat. Good news is here now.
Okie doke. Tell us about the last 8 rate hikes.
Okay, so since the early 80s, there have been 8 Federal Reserve interest rate cycles where they have stopped not doing anything or cutting and have begun raising rates. There have been 8 of them. The following 12 months, the Dow has averaged a 10.8% gain. What does that mean? Doesn't mean the stock market's guaranteed to go up or down. It means higher interest rates may not be a bad news story. I mean, everyone says, "Ooh, geez, things are bad. They're raising rates. That's going to be bad." Yep, it could be, but it doesn't necessarily have to be. And we see this with at least the last 8 rate cycles.
Well, they're not raising rates because they're just mean people.
Right.
They're responding to a situation in the economy
Right.
of inflation.
Right.
And they want to dampen activity, I would guess, so some activity, so prices stabilize.
Mm-hmm.
I'm not sure that is a forever strategy that will work, but it's worked often enough that why not do it?
Right.
So one might expect that when it has done its job, we all come back.
Correct.
Okay, so
And it'll be a combination of rate hikes and what's going on economically in the world. We got a lot of things setting up right now that are going to be somewhat positive for inflation. And my own guess is inflation has peaked. We won't know that until the middle of May when the next report comes up. But I think there are a lot of signs that inflation has peaked, and certain things that are going to allow that maybe to become true. One, there's definitely a slowdown in China. 2, you got what's happening in Europe. 3, you got what's happening here. We got to remember a year ago we were coming out of a pandemic. There was all this pent-up demand to spend, right? And supply and demand is, if you really want my product, right, you'll be willing to pay a little more for it. Mm-hmm. That all feeds into inflation. So when we compare these numbers now versus a year ago, they're most likely going to look better. And if that's the case, then we're going to see inflation look a little better. A lot of people got all bent out of shape when the Fed says it's transitory, and then a lot of people were trashing the Fed by saying, "Oh, yeah, transitory, you're right." Transitory just means it's coming and it's going to go.
right.
But everybody is so short-term focused now that they took that to mean, very short time frame. Not necessarily.
Well, it went from transitory to not transitory.
Correct.
Which meant I wouldn't say a pandemic of inflation, but it continues.
It did. It does. But there are things that are going on now that I think are going to show. And we were wrong this month, right? Probably going to be wrong again. But there are things that are going on now that lead me to think that we're going to see inflation start to tail off. It's not going back to 2%, but maybe instead of the double digits of 10 and 11, maybe it goes down to 7 or 8, and that trend is going to, be a positive.
Okay, taking your point, even if if inflation goes down, might that not be part of a cycle into a recession?
Could be. It's hard to see that right now with, the labor market and the employment market doing so good. With 3.6% unemployment, pretty tough to go into a recession. Too many people are working.
But a lot of people have not gone back into the workforce.
A lot of people haven't.
Today I went to get some stuff printed out at Staples.
Mm-hmm.
The poor guy there, busy.
Mm-hmm.
There wasn't a huge crowd,
mm-hmm.
but he was the only guy at the print station,
mm-hmm.
whereas they probably want to have 2 or 3.
Right.
Why is he the only guy? They can't get somebody.
They can't get anybody. Right.
Why can't they get somebody?
Well,
Because nobody wants the job?
There are studies out there that show, people don't want to go back to work. They don't want to go back to an office. They want to do a hybrid. They want to be able to work from home. That's something that's affecting the economy that hadn't affected the economy in prior decades. And how that's all going to work out, who knows? Nobody knows.
No, yeah.
But there's study after study saying, majority of the people don't want to work 5 days a week in an office or at a job. They want to do a hybrid. Well, and if the job requires you to be there 5 days a week, a lot of them are saying, "Nah, I'll pass."
And they say, what do they do when they say, say to Mr. Skyscraper, a guy who you used to go into the office 5 days a week, but now he wants you to go in, come back to doing that, and you say, hey, I'm out of here. Where are you going? Not, the theoretical, the editorial you.
Right.
As opposed to the editorial we. Where are you going?
Well,
they going?
I think they're looking for the jobs that will allow them to do that, allow them to work from home.
Where are they?
There's a lot more than now than there were.
Well, yeah, but
a lot of back office type functions now are being done at home.
Is there enough of them?
No, there are not enough of those.
So if you can't find the one you want,
mm-hmm.
you don't want to go in the office, what are you doing? And there's a lot of people who are doing that.
And a lot of them have just dropped out.
Yeah.
Just dropped out.
What are they?
I don't understand it personally, but a lot of them have just dropped out.
I'd like to know how they're doing.
Yeah.
And there's a story in that
mm-hmm.
Maybe I'll try to do a little research for next month. I don't know, maybe I won't. But I wonder about that. And if there's anybody in the audience who wants to respond and tell us, please, you're watching us because you left your job with Goldman Sachs because they wanted you to come back in the office. Please call us and tell us or respond to that.
It's more likely they got a bellyache and it's 2 a.m. and they're up and they're using this program as a nightlight. But I think a lot of them would just say, no, I'm not going back. I'm living off of whatever, a severance, savings, tapping retirement early, and I hope that's not the case because that's pretty dangerous to be doing stuff like that.
That is scary. I'm not the judge how dangerous it is, but it is darn scary to me.
Right.
Okay.
The other bit of good news is there's this survey that comes out weekly. It's the American Association of Individual Investors, AAIA. They, sometimes they call it the sentiment indicator, and it's a contrarian indicator. We've said time and time again, the public is always wrong. That's not to knock the public. It's just if you look at the data, public gets out at the wrong time and gets out after the market's dropped. They get in when the market's high. So this week, the bulls minus bears ratio is negative 43%. Meaning there are 43% more people who think the market's going down than they think it's going to go up. It's the worst reading since a negative 51 back in March of 2009. You say, oh, that's a real long time. Yeah, it is. And you know what happened in March of 2009?
The turnaround. It was the lowest point.
It was the lowest point of the stock market in the financial crisis. So the individual investor was the most negative at the ultimate low of the market.
Now, as I think we mentioned before, that's the association, the American Association of Individual Investors, is not a fly-by-night organization.
No.
It's people who study the market. They're generally savvy, and they generally do fairly well. Did on the turn of the month, did they go back into the market? That group, I think, tends to work with fundamentals more than anything else. But I wonder if we took a survey of them and we asked them more granular questions like, do you think this sets the mood for a rise in another month? Do you think we're approaching the end of the world? Do you think this will hold steady? I think that would be a very interesting way of looking at it, and we'll never get that. So,
well, the number did get better as we moved off of March of 09. But the interesting thing was they were the most negative.
Yeah.
At what turned out to be the lowest point.
The lowest point.
They should have been the most positive at that.
For them, I think it's a little irrelevant because they're not going to sell or buy a stock on sentiment. They're not. They call the Association of Individual Investors.
Right.
They could name that the Association of Individual Investors in Individual Stocks.
Sure.
So a mood change wasn't a big thing. I mean, there are stocks that do very well in bad times.
Correct.
So they probably knew those stocks.
Correct.
But
this is just an aggregate of all
of their sentiment.
Right.
And they were right until the next month. I'd like to know what their next month, the next month of April 2009.
That would have been good to know. I didn't bother looking at that.
I'm sorry. I don't want to
No.
beat you up.
I'm just saying that it's kind of ironic that that group, which, you would think know everything, they were the most negative at the absolute bottom.
Well, the April 2009 might have gone down to 40%.
Yes, it might have. It would have. It did improve. Obviously.
May go down to 29.
Yeah,
30,
absolutely.
Yeah.
But I mean, again, it's an indication that there's a lot of emotion involved in this.
Well,
and you have to take the emotion out of it, really, because it's going to lead you to make the wrong decision. I mean, when are you most fearful? After something bad has happened, because you think, it's going to get worse. Most times than not, the exact opposite happens. It gets better, right?
Well, I believe in getting emotion completely out of this. So that's why I go for statistics that are based on whether or not the Red Sox lose the home opener.
Absolutely. We've not had a lot of luck this year with sports. We lost in the NCAA, but we had a lot of hope with the Red Sox because they were opening against their home opener. The Fenway opener was against the Twins, and since 1901, the Twins have been the home opener only 3 times. The Red Sox have won all 3 games, and those years the market gained an average of 18%. So all we needed to do, the Red Sox could finish the year 1 win and 161 losses, and it'd still be good. What did they do? They lost the first game. So again, looking for some hope. If someone says, well, what do the Red Sox have to do with the stock market? Well, some could say, what does anything have to do with the stock market, really? I mean, the stock market is an emotional thing, right? You feel good, you buy, you don't feel good about something, you sell. You know, you ask somebody, what do they own? And they don't even really, most people don't even know what they own. Oh, you know, he or she has got me into this, that, or the other thing. But, oh, okay, do you know what it is? I really don't know what it is. So why would you think that has any more weighting than the Fenway Park Open?
Ladies and gentlemen, there you have it. Sell everything and head for the hills.
Well, but that's balanced off with some really good news, and I'm betting personally that the good news is going to outweigh the non-scientific bad news.
Wait a minute now.
Non-technical bad news.
Fenway Park for me is a cathedral, if not a basilica.
Okay.
So anything that happens there
takes precedent. Well, they better start winning, because I think as of today they've lost twice as many as they won, and they seem to be losing a lot in the 9th and 10th innings lately.
We'll be broadcasting next month from the bunker.
No. Next month we're going to be outdoors. It's going to be great weather, and
heck, it's great weather today.
It is.
I wish we were outside.
This is the first good day of the year weather-wise.
Yeah.
I mean, we don't have the wind and we have the sun. We like to look at the economy. Economic stuff still looks pretty good. You know, I mean, I think inflation's gonna. I'm betting we've seen the worst of inflation.
You're not thinking stagflation?
No.
Okay.
No. Leading economic indicators. No sign of a recession. You know, people say, "Oh, we're going to head into a recession." Okay, explain how. Well, one of the indicators is the leading economic indicators. You have to see 3 negative months in a row. We had 1 negative month 3 months ago. The last 2 months have been positive. So I don't think you're going to see a recession. Now, are you ever going to see a recession? Sure. But I don't think it's something that's going to happen, in 6 months or so. Jobless claims, fewer and fewer people losing their jobs. Latest number comes out on a Thursday was 180,000. That's the lowest number since 1969. And tell you how strong the labor market is. The labor market today is twice the size it was in 69.
Yeah.
So that's, I mean, you can't say anything negative about the job market. People are not losing their jobs, and people are finding work, because the flip side of the jobs market is the employment report. History shows you need 159,000 new non-farm jobs created a month. Last month we had 3 times that. So what we have to try to do, our problem really, I think, is not job related, it's inflation. And I think a lot of that inflation is caused by the pent-up demand of all the worldwide closures that opened up a year ago. And at least that's what I'm pinning my hope on. And if that's true, then I would say inflation has peaked.
Cross those fingers, people. And
Look.
We believe in Mike.
Look at the numbers in the middle of this month, mid-May. You don't have to wait for us at the end of the month. You'll know mid-May when the new inflation numbers come out. I bet you they show a little bit of a downtick.
I'm not going to be the other side of that bet, because I'm not a betting man. But if you want to call in and take Mike's bet, can you tell the people where you are so they know?
Well, I'm at 400 Southbridge Street in Auburn, Webster 5 Cent Savings Bank. Anyone who knows that location, it's basically across the street from what used to be a Sears, the Auburn Mall.
Moment of silence for Sears, yep.
Yep. Yep. And so, you know, I think the big thing is relax. Nothing's really changed. You're waking up in the morning, you're going to bed at night. Things happen during the course of the day, but you know, things will happen during the course of every day. And I don't get too excited. I mean, I don't like it when it's down 1,000 points. But that comes with the territory, right? It goes up, it goes down.
It does.
Try to focus on something concrete that you can compare it to, rather than get wrapped up in the news station of your choice, whether it's CNN, MSN, CNBC, Fox, whatever. Try not to get wrapped up in that. Try to focus more on, okay, they're talking about inflation's really bad, but let me see how inflation is today, and let me see how it was 6 months ago, a year ago, 2 years ago, 10 years ago. You look at the numbers as opposed to, you know, somebody's comments that are their opinion, which may be right and may be wrong.
Well, you generally have been right. So we're going to assume that we have a steady hand here. And thank you, Mike, for coming and guiding us through it.
Always great to be here.
This has been
The alternative is not good.
I'm not going to argue that.
Okay.
Thank you, Mike, for being on the Long Hill Report and Conversations With, and please come back again next month.
Sounds good.
Thank you very much, ladies and gentlemen.